This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and an adjunct professor of accounting and financial management. For this class, we will follow the excellent text by Brigham and Davis, Intermediate Financial Management. In this video, we will cover the second half of the chapter on risk and return, part 1. If you are taking on more risk by investing in a high beta stock, you should require a higher rate of return to do that. So investors require a rate of return for just investing and tying up their funds for a certain period of time. We call this the risk-free rate, which is the treasury bill rate or the rate of a bank account. In recent years, this has been suppressed to zero by the central bank, the Federal Reserve System, printing money, but normally over time, it is generally around 3%. Investors would require a return for risk beyond that, which is the extra return above the risk-free rate that investors require to induce them to invest in a high-risk stock, which we call the risk premium, RP. RP is the market risk premium. It is the extra return above the risk-free rate that investors require to invest in the overall stock market. So it is the expected rate of return of the market, S&P 500 expected rate of return, minus the risk-free rate, or the treasury bill rate of return. The capital asset pricing model defines the risk premium for stock I as the beta of I times RP market. The security market line puts these pieces together, showing how to determine the return required by bearing an individual stock. The rate of return of the stock is the risk-free rate or the treasury bill rate, plus a measurement of the riskiness of the stock beta times the risk premium of the market. So risk depends on beta. The part of sigma p due to an individual stock is the weighting in that stock times the market standard deviation times the beta of that stock, and the required rate of return for an investor to be willing to invest in that stock is the risk-free rate plus the market risk premium times beta. For example, if beta is 0, then you are investing in a treasury bill or a bank account. You get a 0 here. The security market line rate of return is the risk-free rate. If you invest in an average stock beta of 1, you get a 1 here, and therefore R sub I equals R risk-free plus the risk premium of the market, RM minus R risk-free, which is just RM again, are the S&P 500 rate of return. So a beta above 1 would be a high-risk stock like a high-tech stock. A beta below 1 would be like a public utility. A beta of 0 would be a T-bill. And a beta that is negative, sometimes something like gold or oil, could actually act as an insurance product. And you might get a lower rate of return by investing in it, but it would lower the risk of your overall portfolio. This system is sort of set up like the Celsius temperature system, where 0 is freezing, 100 is boiling, and then you have a line between them. If we look at Blandy stock and we use the correlation function in Excel, we can find that the correlation of Blandy stock with the market is 0.481. And again, we will go over how to use the correlation function in Excel in another video. So Blandy is roughly half correlated with the market. So if we use the standard deviation for Blandy and the market, we have beta of Blandy is going to be the 0.481 correlation coefficient with the market, times sigma b, the standard deviation of Blandy, over sigma market, 0.201, and we get a beta for Blandy is 0.6. So the average beta is equal to 1, so Blandy stock contributes less risk to a well-diversified portfolio than does the average stock. The required rate of return for Blandy is then going to be the risk-free rate, which we'll say is 4% if the T-bill rate is 4, plus the beta of Blandy we just calculated at 0.6, plus the risk premium above the market, and in this example we are saying that is 5, so we have 4 plus 0.6 times 5, or 3, gives us the required rate of return to be willing to take on the risk of investing in Blandy of 7%. The beta of an average stock is 1, which is the beta of the stock market. So the rate of return of an average company is going to be 4% plus the beta of 1 times the market risk premium of 5, or 9. We have looked at two different stocks, one high risk, Grammage, with a beta of 1.3. Its required rate of return is 4 plus 1.3 times 5, or 10.5%. And then a low-risk stock like a public utility, Blandy, which has a required rate of return of 4 plus 0.6 times 5, or 7. So sort of a high-tech, high-risk stock and a low-risk public utility. How do we get a beta from historical data? Another way to do it would be to run a regression analysis in Excel to estimate the beta. Here is graphical data of Blandy's rate of return on the y-axis and the market rate of return, like the S&P 500, on the x-axis, and the slope of this line from the regression analysis would be the beta. So the slope, when we run the regression analysis, we end up with y equals 0.6027. That would be the slope times x. You could also use the Excel slope function, put in the y values in one column and the x values in another column, and get the same result. For most stocks, you could look up the beta. Finance.yahoo.com generally lists the betas for the stocks, and so does ValueLine.com. Most stocks have the betas between 1.5 and 0.5. What about if things change? If the Federal Reserve increases or lowers interest rates? Well, if interest rates go up, the security market line is shifted in a parallel manner up, so the required rate of return of the stock should go up. This means if the Federal Reserve raises interest rates, in general, stocks should go down in value. How about risk aversion? If the animal spirits cause everybody to panic and get out of the stock market, that is an increase in risk aversion, and you should have an increase in slope or more compensation for taking on risk and investing in the stock market. So when everybody else panics, you want to buy. Buy when others are fearful, sell when others are greedy. If we look at a portfolio and we want to calculate the weights for a portfolio with 1.5 million in Blandy and 0.6 million in Grammage, then our total portfolio is 2 million, and the weight in Blandy would be 1.4 divided by 2 million, or 70%, whereas the weight in Grammage would be 0.6 million divided by 2 million, or 30%. And betas, unlike standard deviation, are linear, so the beta of a portfolio will be the weighting of each stock in the portfolio times the beta of each individual stock. For example, our portfolio beta in this case is going to be 0.7, the weighting in Blandy, times 0.6, the beta of Blandy, plus 0.3, the weighting in Grammage, times 1.3, the beta of Grammage, are 0.81. How do we calculate the required rate of return on this portfolio? Well, we can do it with two different ways. First, we can use the security market line and the beta of the portfolio we've calculated, and just say the required rate of return of the portfolio is 4%, the risk-free rate, plus 0.81 the beta, times 5 the market risk premium, equals 8.05%. We could also use a weighted average of the individual stocks' required rates of return, and then we would have 0.7 times 7%, plus 0.3 times 10.5%, are 8.05%. Another thing you could use the capital asset pricing model for is to evaluate the performance of portfolio managers. Consider two different managers, JJ and CC. JJ has a low-risk portfolio with a beta of 0.7, CC a high-risk portfolio with a beta of 1.4. The required rate of return on JJ is 7.5. The required rate of return on CC is 11. And again, you would get this from 4 plus 1.4 times 5 is 11. And 4 plus 0.7 times 5 is 7.5. If the actual performance of these managers is 8.5 for JJ and 9.5 for CC, then we would take the portfolio actual return minus the required rate of return to get the over or underperformance. In this case, we have an overperformance of 1% for JJ and minus 1.5 for CC. So even though CC outperformed JJ, if we adjust for risk, CC underperformed what was required, and JJ was the better portfolio manager than CC. Graphically, we can show the security market line with the performance of these different portfolios. CC is below the security market line, JJ is above the security market line. So JJ has shown to be a good portfolio manager and CC has underperformed. You can use the same sort of analysis to determine whether a stock is a good buy or whether it might be a short selling potential. Why can there be a difference between intrinsic values and market prices? If we want to calculate an intrinsic value, we would need to know all relevant available information, have unbiased expected future cash flows, an unbiased measurement of risk, and we would use this and a model like the free cash flow model to calculate the intrinsic value of a company. If we look at market values, well, we have perceived future cash flows. Some people may think a company is going to grow a lot quicker than it is. We may have perceived risk, and perhaps a company, a high-tech company that is far riskier than the reality is and has much lower cash flows than the perceived future growth. People may then come up with a market price in that example that could be well above the intrinsic value. So if these two are equal, then the market would be in equilibrium. If the market price is above the intrinsic value, then you can be in something like a stock market bubble. On the other hand, if the market price is way below the intrinsic value, you would have a very good buying opportunity, say like in the late 1970s when the market was really beaten down. So for the market to be in equilibrium, the market price has to equal the intrinsic value. It is easy to know the market price. It is not so easy to know the intrinsic value. How is equilibrium established? Well, you have tons of analysts on Wall Street trying to determine what a good stock buy is, and then buying those for which they believe that the market value is above the intrinsic value. Are markets efficient? Are all of these analysts analyzing all of these stocks doing a good job? Well, the efficient markets hypothesis from the University of Chicago asserts that when new information arrives, prices move to the new equilibrium price very, very quickly, and therefore any mispricing can easily be eliminated by, we'll say, high-tech computers on Wall Street with programs in C++. If the efficient markets hypothesis is correct, stocks are normally in equilibrium. One cannot beat the market by consistently earning a return higher than is justified by a stock's risk, and you're better off just going to Vanguard and buying an index fund rather than trying to analyze the stock market yourself or paying the extra fee for a portfolio manager that manages an active portfolio as opposed to an index fund. How can we test the efficient markets hypothesis? We'll choose a trading strategy and implement it over a large sample, pick an asset pricing model like CAPM, measure the required return of the strategy's investment, and measure the actual return. If you get a return above the higher or the required rate of return, you reject the efficient markets hypothesis. If, on the other hand, you cannot consistently outperform the market, you would have to believe markets are efficient. There are three different forms of the efficient markets hypothesis. The weak form is just current prices and maybe things like volume are already reflected in the information contained in past prices, so you cannot earn excess returns with strategies based on past prices. An example strategy would be invest in stocks that have declined below the previous 52-week low. These things are called technical analysis, and most of the time they do not work. So most of the time we could say the weak form efficient markets hypothesis is correct. There might be some exceptions to this. Momentum strategies, stocks that have been going up tend to keep going up. Of course, suddenly they may drop very quickly. You could also do long-term reversals to the mean over a very long time period. Perhaps if prices get way above their mean prices, you could have an excess rate of return. Semi-strong form efficient markets hypothesis says current prices already reflect all publicly available information. So analyzing a company is fruitless. A strategy could be invest in stocks with past 5-year annual earnings growth rate greater than 10%. This is a form of fundamental analysis. And again, most of the time, active portfolio managers underperform indices. So most of the time, you would say that semi-strong form is correct. There are exceptions. Smaller companies that aren't analyzed that much on Wall Street tend to outperform the market. And over a long enough time period, deep value strategies like companies with high book-to-market ratios tend to outperform the market. And some of this could be due to things like bubbles and manias, but most of the time it's hard to beat the market. Your best chance would be, again, in small companies that aren't being analyzed and that really large mutual funds can't really invest in because they move the company around too much. The strong form efficient markets hypothesis believes that even inside information is embedded in the stock price. It's clearly not true if you know what company A is going to buy out company B at a 20% premium and you invest in company B, you can make an excess profit. Of course, at least in the United States, insider trading is illegal. That is not the case in all countries around the world. What about market bubbles? Are they consistent with the efficient markets hypothesis? Well, they're hard to identify, and they're hard to short if you can identify them. If you look at something like the dot-com bubble, there was a large fraction of people that believed it was ridiculous overpriced, but all you could do is sit it out and then underperform. People that tried to short, well, it can become even more ridiculously overpriced. So this could be an argument that in several cases, the dot-com bubble in 2000 and perhaps a current dot bubble today, the markets are not efficient and they are way overvalued. But the solution to these things, again, shorting is highly risky and hard to do. So maybe markets are efficient, maybe they aren't, but it's hard to drive them back to efficiency and make a profit. So bubbles are very hard to puncture. Shorting strategies are dangerous, and as they say, the market can stay irrational longer than you can stay solvent. Most of the time, stocks are reasonably efficient. Most of the time, index funds out of companies like Vanguard outperform the market, but there are bubbles and probably manias, and there certainly are time periods that you could be wise just to stay out of certain markets for a certain time period. So the bottom line is CAPM is useful. It's really hard to test it. Most researchers don't just use a one-factor model like beta, but use multi-factor models to attempt to identify a stock's intrinsic value. CAPM has not been completely confirmed or refuted. It is a useful model to try and think about risk, and it is certainly regularly used in the markets and at companies. I thank you for watching this video.